Welcome to the Torch Academy. In this episode, we're walking through the step-by-step process of recasting financial statements, the way buyers actually do it. Why does this matter? Because you have been running your business to minimize taxes. That is smart. You have probably been pushing expenses, timing things right, taking everything you can deduct. But when you sell, a buyer does not care how much tax you paid. They care about what the business actually earned. If you bought office furniture for $20,000 and expensed it, that reduced your tax bill, but it also reduced your reported income. A buyer will add it back because it is not a recurring expense. Same with owner salary, personal expenses, one-time costs. Recasting is how you bridge that gap. Here is the simple 4-step process. Step 1, start with net income from your actual tax return. That is your baseline. Step 2, identify everything that does not belong in valuation earnings and add it back. We will get into the specifics in a moment. Step 3, normalize for unusual years. If you had a one-time lawsuit that will not happen again, remove it. If you had an unusually good year, consider what is repeatable. Step 4, what you are left with is recast earnings. What a buyer thinks the business will actually earn in the future. That number feeds into every valuation method. Let me walk you through the big adjustments. Owner salary is the most common. You probably pay yourself a salary, but a new owner will pay themselves too. So you add your salary back to earnings. That shows what the business actually generates before owner compensation. Personal expenses. You drive a company car, the business pays your phone, your health insurance, maybe some travel. A new owner might do the same things differently. Add these back. One-time costs. Your roof needed replacing, you settled a lawsuit, you bought new equipment. These are not recurring expenses. Add them back. Same with non-recurring losses. If you wrote off worthless inventory or bad debts that were specific to that year, add them back. Above market rent is interesting. If you own the building and you rent it to your business at artificially high rates to move profit out, a buyer might adjust that. The principle is simple. Only keep the recurring normal operating expenses. This is eye-opening. In my experience, when owners recast their financials, earnings typically jump 20 to 50%. Why? Because they have been running their business for tax efficiency. A $150,000 tax return net income often becomes $200,000 to $225,000 after adjusting for owner salary, personal expenses, and one-time costs. That is not fraud. That is just revealing what the business actually makes. And remember the valuation math we covered earlier. If you add $50,000 in recasted earnings and you are using a 3x multiple, that is $150,000 added to your business value. This is massive. Let us work through a real example. Your business filed a tax return showing $150,000 in net income. But let us recast it. You paid yourself an $80,000 owner salary. Add that back. The business paid $8,000 for your health insurance. Add it back. You have a company car you use for personal driving. The business spent $12,000. Add back 100% or adjust for personal use percentage. Travel expenses, some were personal. Add back the personal portion. And you bought $15,000 in new equipment as a one-time capital item. Add it back. When you add all that back, you get to $270,000 in recast earnings. That is 80% higher than your tax return showed. Now, when you value the business at 3x earnings, you are looking at $810,000 instead of $450,000. This is why recasting matters so much. Here is where people get confused. You adjust for items that are owner-specific or non-recurring, but you do not add back things that are legitimate operating expenses. Rent is real. Utilities are real. Employee payroll is real. Insurance is real. These stay on the P&L. You are not trying to make the business look better than it is. You are trying to make it honest. If the business needs insurance, the earnings should reflect that cost. If the new owner will need to pay employees, that is part of the sustainable earnings. Adjust for owner-specific things and one-time events. Leave legitimate operating expenses alone. And be careful not to double count. If you already included your salary in the P&L, do not add it back twice. Be systematic. Here is the trap most owners fall into. They see recasting as an opportunity to make the business look as profitable as possible. So they add back everything. Then they add projections for improvements they have not implemented yet. They adjust for market potential. This kills credibility. Buyers are sophisticated. They know recasting adjustments exist, but they check them. Anything that looks like you are inflating earnings gets challenged and often removed. Keep adjustments to documented, historical, owner-specific, or clearly one-time items. Anything speculative gets rejected, and it makes your whole number look suspect. Integrity in recasting builds confidence. Here is the critical part: documentation. For every adjustment you make, you need to prove it. Your own tax return is the starting point. For personal expenses you are adding back, you need invoices or credit card statements. For one-time costs, you need documentation that it is actually one time. This is not paranoia. It is how business is done. When a buyer or a lender reviews your financial package, they are going to ask about every adjustment. If you say you add back $20,000 for a lawsuit settlement, they want to see the settlement agreement. If you add back $12,000 for your personal car, they want to see the expense records and understand the percentage. Good professionals and accountants do this systematically. If you cannot document something, do not include it. It will just create friction later. If you are not comfortable doing this yourself, get help. Your CPA or accountant can review your tax returns and identify standard recasting adjustments. It is not expensive, usually a few $100s. A business advisor can help as part of a valuation opinion. And if you need something more formal, maybe for financing or legal documentation, a certified appraiser will prepare a detailed recast statement with all the supporting schedules. Start with your accountant. They already know your returns. They can do a quick analysis, identify obvious adjustments, and get you moving. Then, when you are closer to selling, an online platform or appraiser can do a more thorough job. Here's what to remember. Recasting isn't creative accounting. It's revealing the true economic benefit of owning your business. Owner salary, personal expenses run through the business, one-time costs, and non-cash expenses all get added back. On a 3x multiple, every $10,000 add back you document is worth $30,000 in sale price. Be thorough and be honest. Thanks for watching. If you found this helpful, head over to torchapp.io/signup to create your free account. Torch uses AI to help you navigate buying or selling a small business, whether you're just exploring or ready to make a move. And don't forget to subscribe for more episodes from the Torch Academy.